Welcome to This Week in Money. I'm Jim Goddard. This week's show is on BitChute at Talk Digital Network. Today, Ross Clark from chartsandmarkets.com runs down the major markets. New York did not like what it heard from Fed head Jerome Powell. Ross says everything seems to have taken a hit besides the U.S. dollar and crude. Publisher of the VR newsletters on vrtrader.com, Mark Leibovit, doesn't see any relief from rising interest rates until the economy has been pushed down. He also has a special offer for our listeners. Market historian Bob Hoye from chartsandmarkets.com weighs in on the U.S. student debt forgiveness program and the irony of China having to shut down EV charging stations. Plus, at the end of the show, we'll have a company showcase update from American Manganese CTO Zarko Meseldzija, now doing business as recyclable battery materials. We'll talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
Good to be with you, Jim.
Ross, Fed head Jerome Powell spoke at Jackson Hole, Wyoming, and apparently the stock market didn't like what he had to say.
Stock market didn't like it. The U.S. dollar did. They're talking about, he's of the mindset that rates are going to have to go quite a bit higher, enough to cause some real pain in the economy. And 75 basis points seems to be in the cards. And with that, U.S. dollar had a pretty good run at the end of the week. We've been thrashing around all week long, really, with markets not going anywhere until Friday. And then the dollar index ends up right back to its highs of the year. And with that, probably, all but maybe the energy markets are down anywhere from 3 to 4%, pretty much across the board. This is, we've had a good technical bounce as far as most of the stock indices were concerned coming out of June, July, up to decent resistance. Most of the indices have retraced a good 38 to 50%. Gave back some during the early part of this week, and then the bounce, they just was not going to have any staying power when the Fed gets its mindset as it is right now. So this takes us back to the mindset of what happened with Volcker when they were clearly making the move there to stop inflation and being willing to put up with whatever it did to the economy.
You said energy seemed to be the only one surviving this minor correction. How did it do?
Yeah, so we're looking at crude oil sitting at $93, up 50 cents on the day, but a decent close to the week. Had been down at the $85 level at one point. But the overall, we've got most markets just sitting in these trading ranges, and the crude oil is a classic in terms of just being in that range, managing to at least be at the top end of the range, but no breakouts to speak of. Everything just biding its time right in here.
Any reaction from the precious metals market?
Down $21 on the oil, on the gold market, down badly in the silver. And once again, you take it all back to what's going on as far as the currencies are concerned. And I don't think you really, at this point, have a hard time reading too much more into that. I think that the resistance levels that we've seen on the bounces this week are the ones that we're going to be looking at as we move forward through September. And we were of the mindset that we might have seen some buoyancy into September and then dropping off after that. Well, we've got a jump start as far as that move is concerned right now. So I think from a technical perspective, which is where I always drop back to, I have to look at it and say most of these trends are intermediate right now in terms of being under pressure, and they're going to have to prove themselves otherwise.
Ross, thank you so much for the update.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at ChartsByRoss. Coming up, Mark Leibovit, next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as VRTrader.com. He's speaking to us from Arizona. Welcome back to This Week in Money.
Glad to be here. Real exciting week in the markets, Jim, so good timing.
Do you have a special offer for This Week in Money listeners?
I do. If you go to VRTrader.com, that's Victor Robert, VRTrader.com. VR stands for volume reversal, by the way, which is my technical tool. But you go to VRTrader.com and you go to any one of our newsletters. There are about 5 or 6 to choose from, and you enter in the promo code SPOT, the promo code 2022 half off, 2022 HALFOFF, and you get 50% off any of our subscriptions.
Mark, what did Fed head Jay Powell have to say Friday in Jackson Hole, Wyoming?
Really, there was no surprise to me. I love Jackson Hole, by the way. A lot of discussion about, bear beware, which is sort of funny because when you're in Jackson Hole and you're in that community, the bears are all over the place. And when I've been there, you're watching those signs that tell you to watch out. So the bears definitely took control of Powell in the market on Friday. And, he said he's going to pretty much keep at it in terms of raising interest rates, and he also suggested we're going to have some pain in the market. So when the market heard that, it slipped on the bar soap in the shower, and Dow dropped 1,000 points. So it was no surprise. I mean, technically, all our work was saying we're getting a rally in a bear market. And now the question is, are we going to test or break the lows? We're in that, September, October traditional negative period. Nothing is carved in stone. You could still get a year-end rally, and the question is, does it come from a lower low or a retest of the lows? A lot of manipulative forces out there, so we'll see what happens. But, he pretty much said, you guys watch out. I'm going to try to get inflation back down to 2%. And in my opinion, no way in hell is that going to happen.
With interest rates being on people's minds following expected September hikes in Canada and the U.S., are the higher interest rate campaigns likely to continue after the next round of hikes?
What I have to say is going to scare a lot of people because, we're looking at 8-9% inflation and the Fed trying to get it down to 2%. And, of course, my timing could be off and it could take a few more months or longer. But I wouldn't be surprised before this is all over. You'll see interest rates much higher and you'll see inflation at 20%, not at 8 or 9% where it is now, because the Fed really has no control of what's going on in Europe with the potential war which I feel is going to unfold in that part of the world because of what's happening, both in terms of the U.S. policy and what Putin wants to do. And then, of course, we got China, Taiwan. We got so many issues around the world right now. And the inflation surge we saw, I just thought is sort of temporary one. So, Definitely it's going to happen, higher rates, and unfortunately recession might be a mild word, which could come out of all this if they keep it up. And look what Paul Volcker did back in the 1970s when he drove interest rates up toward 15% or more, and killed a lot of businesses. Eventually we came out of it, but it was an overreaction. And we're assuming that the Fed's policy is controlling the world and the reasons that we're having inflation, and that's not really the case. We have shortages of food, we've got supply chain issues, we've got potential war, we've got geocosmic issues that are always a risk out there, all kinds of stuff that the Fed really has no control over. And in fact, the main thing I say is when you ask me about the Fed is that my question is, why isn't it abolished, and how fast can we get it abolished?
We're hearing inflation is peaking. Is this just wishful thinking?
Yes, I just pretty much stated that. Yeah, we may see a pullback. But, as things unfold, and, we come into 2023 next year and so forth, I just see much higher inflation. And, unfortunately, even if I'm wrong, the push for higher interest rates is going to kill a lot of business and slow things down. And it's the wrong medicine for the sick patient.
Is real estate looking significantly vulnerable to a downturn that could turn into a crash?
I'm hearing this, and common sense says, you should see a retracement. We're starting to see real estate prices back off a little bit, at least here in this part of the country, because of the higher rates. But historically, rates are not as high as, they were years and years ago. I remember, going way back to when we had inflation like this in the 1970s. I mean, mortgages were up like 15% or crazy numbers. So, they're still around that 4 or 5% level. But I guess if they go higher, it will put pressure on sellers to sell and buyers to back off a bit. And I don't want to call a crash impossible. I mean, anything is possible, It just depends on where you are in the country. Certain segments are going to do better than others. I would say, cautious optimism, but if inflation goes to 20%, which is what I think could happen in the next year or two, I think real estate would do well. It would increase in value because it would be a physical asset that could be a hedge, just like people buy gold and silver or other physical assets for hedges in a super inflationary environment. We're assuming that we're going into deflation, and I don't think that's necessarily the case. So I'm sort of on the fence with the real estate. Pull back now, yes, maybe, but I think if the realization comes, and if I'm right and inflation continues, I think real estate could resume its uptrend.
Do gold and silver still have a relationship to inflation?
It's a joke because it's a manipulated market. We've talked about this ad nauseum, and I talk to a lot of gold people and silver people, and technically, we hit a big double top in the gold market, comparing the last 4 years of trading, and until we really break through those levels, I don't know if the manipulative forces which are out there that control the markets. I mean, we have the government in there for decades supporting supporting the deflationary gold theory, do whatever they can, sell contracts at the COMEX, try to suppress price. A lot of documentation on this. I'm just not making this stuff up. A lot of it comes from GATA.org, which I've mentioned before, research arm of Bill Murphy's company, and check that out. So, in theory, the answer to your question is gold and silver should be taking off, and they're not. Why isn't gold, with 8-9% inflation over 2,000? Why isn't it 2,300? In truth, the matter is, if the metals weren't suppressed by governments for recent decades, gold would probably be several times higher than it is now. Probably should be $8,000 to $10,000 an ounce. But governments don't like that. They don't want to see gold and silver strong because it diminishes the strength of government, diminishes the currency. So, yes, there is a theoretical relationship, and they should go higher, but until somebody pulls the plug on the manipulation or something else happens that I'm unaware of, until we break out into new highs, that means the stops have been pulled, so to speak. They're not active being, in the market trying to force it down. then I can jump on board and start saying, hey, now we're in gear and maybe we can really run here a little bit. So I think it's always good to keep a little gold and silver in your back pocket because it's lasted for thousands of years, whereas currencies and countries come and go. But I can't say it's going to run today or not, so I'm watching it and keeping just a little bit as a hedge.
Looking back, could June 17th have been the bottom of the bear for the stock markets?
It could have been. We won't know. I don't think it's the bottom. It may be a bottom for a while. I mean, what's funny about the June 17th low, and I get criticized for this a little bit because I do a lot of geocosmic stuff, as you know, but June 21st was the summer solstice, and we get change of directions many times around the solstices. So the next big one coming up is September 23rd, which is the autumn, or actually the autumnal, they call it, the equinox. And we'll see where the market is. In theory, it would be a low point, like June, since September tends to be down. But if they pull the rabbit out of the hat and the market rallies into that time, I guess that could happen as well. But it is a time you got to watch. So the fact that it occurred on the summer solstice, the June 17th that you referred to, and it really depends how low we go in September. And that may have been the low for the year because some of our models even say we should or could get a year-end rally. So does that come from a lower low under June 17th, or is it a retest in the September period that I'm referring to? So we're just going to have to watch it. So it's sort of a theoretical question, but are you trading the market? I mean, we were short today, made some nice money for our clients on paper, recommending and talking about inverse ETFs. So we just take it a day at a time, and we'll see how it plays out into September.
What are you seeing for the U.S. dollar, short term and longer term?
I got to be a bull on the dollar, which is not so good for gold and silver, as history says, though there are times they could run together. It's the last horse in the glue factory, so to speak. I don't see it going down, particularly if there's war, and whether it's in Europe or it's in Taiwan or it's Iran, Israel, or whatever's going on here in the next couple of years, because I do think we're in some type of war cycle. So it's clear. I mean, governments look at the U.S. funding, sending billions of dollars into Ukraine and trying to shore up Europe against Russia, so to speak. And you see what's going on in Taiwan. So money flows into the stronger currency, and I know the ruble has been strong because it's been backed by gold, and Putin has been smart doing that, and there is a big movement to try to get the dollar, pulled as the currency of exchange around the world. But for the time being, I think it's still a bullish case for the dollar.
Do crude oil and unleaded gasoline need a weaker U.S. dollar to move higher?
No, I think it's a function of demand for crude oil and gasoline, and it's being manipulated here. I wouldn't be surprised if some of the pullback we've seen in crude oil is a result of the government in there and the futures markets hitting the bids like they do in gold and silver. We know that some of the emergency national reserve or whatever they call it in the U.S. was released, but we were also told some of that was sold overseas, some to, believe it or not, China. So there's still demand for crude oil around the world, and even if you believe totally in electric vehicles, you realize that it takes a certain amount of crude oil to produce those vehicles. So then we got winter coming up, particularly in Europe, and there's going to be shortages there. So I sort of view crude oil as a big bull market, regardless of all the restrictions and negative comments and negative press and the green movement and all the stuff that we hear about. And over the next decade, it may be a lot sooner, we could see crude oil at several $100s an ounce as insanity rules Washington. And
you mean a barrel, not an ounce.
I mean, you're right. A barrel's correct in terms of, their actions to try to depress it. So let's see what happens.
Agriculture is under attack by climate police forces being formed in a number of countries. What could this mean for food supply and agriculture markets?
Well, we're already seeing it, in the ETFs in the past year or so. We're long, some of the ETFs that represent corn and soybeans and agriculture and so forth. And whether it's the climate police that you're referring to, And that's really true. There was an article just last, it's not a news story, but the Amish group in Pennsylvania are being attacked by the U.S. Department of Agriculture because they don't like the way they're growing or distributing their food, which obviously, is just another form of the climate police at work. I know that's going on in Canada and other places, but food supply should become shorter in availability, and prices go higher. So I think all the exchange-traded funds in agriculture continue to do well, and this has nothing to do with climate policy as well. It has to do with climate changes around the planet, volcanic activity. We've seen some of that, again, more of the geocosmic effects, a war, all kinds of crazy supply chain issues. So I think there's going to be a push. You already see it now. I mean, I don't know how it is in Vancouver, but I go into the stores, into Costco or into any of the Trader Joe's or even some of the big supermarkets, and there's less food on the shelves than I've seen in the past. There are some shortages already raising their ugly head here, so it could get worse, and I suspect it will.
Pandemic narratives seem to be yesterday's news, and climate change narratives seem to be today's news. Is this good for some market sectors and bad for others?
Well, it's good for energy, and I am bullish on, crude oil, as I mentioned. I think natural gas as well, but it's also good for the solar industry. I mean, stocks like First Solar, which is one of the big names in the solar industry here, with the market down 1,000 points, I think it was unchanged on Friday. Actually, it was up earlier in the morning, and also a lot of government subsidies and support for it. So I think, solar is going to do well, and that's definitely an area. And then I still think, your electric vehicle market, you got to trade some of these stocks. They're very volatile, and of course, it's years away before the mandates come in where everybody, like they're saying in California, was it by 2035 or some date, all have to own electric vehicles. So the wind is at the back at the industry, but there's a lot of time between now and then. So anything related to alternate energy too. I mean, there's companies like Plug Power and others and other companies that are into hydrogen power. There's a whole list of them, and I've compiled a name that we can put on in our newsletter. But a lot of anything in alternate energy and solar, I think, definitely would benefit from this the climate change narrative, which, by the way, I think is a bunch of nonsense. I think, we go back in history, millions of years, there are plenty of times when the planet warms up and there was no mankind around pouring CO2 into the atmosphere. So, again, it's a phrase, it's a movement. Everybody's excited about it. We all want clean air, but it's a planetary situation, not a man-made one.
Is the supply chain seeing any improvements?
I'm not really sure about that, Jim. You hear some stories, but some of the stories, like in the semiconductor space, I've read and heard that even though government is behind increased production and so forth, there's still some shortages. So I'm sure in some areas there might have been some improvements, and I guess over time it will be solved, but I can't say for sure whether there's a dramatic improvement. I think it's mixed.
We're hearing the deep state could be in panic mode. Is there any truth to this? Could danger and market volatility be ahead?
We're getting into a whole political discussion. I mean, the deep state, the secret government, has been something I've been writing and talking about for decades. And they call it the deep state or the swamp, but it's been around forever. It goes back for decades, government cover-ups of all kinds. You can talk about the JFK assassination. You can talk about extraterrestrials and UFOs, particularly the Roswell incident back in 1947, and cover-ups there. I mean, we go on in terms of government cover-ups. So I don't know if they're in panic mode or not. I think until we get rid of them, until we really close down the deep state and get rid of all these people, I don't know if they're panicking or not right now. I hope they are, because they're not good for the world or the country. And unfortunately, the only way out of it is you literally have to fire everybody in these government agencies and start fresh and hope that you get some good people in there.
Is the U.S. at war against its own people?
No question about it. You got the Democratic Party. It's just by letting immigrants cross the border in Texas and Mexico, and just letting people in with no regard to their background and no regard to their health conditions and no scrutiny as that we have in laws that are already on the books. why would a government do this? It's obviously to their own self-interest. They're trying to get reelected, bringing people into the country. Hopefully they create votes to stay in power. That's what it's all about. And unfortunately, hiring 80,000 Internal Revenue Service agents, which is part of a recent legislation here in the U.S., that's an attack on its own people. No question about it. What do you need IRS agents with weapons running around the country? This reminds me of the brown shirts story from Nazi Germany. So unfortunately, we have bad people in government, and they're doing bad things.
Getting back to the push to buy electric, how are electric vehicle sector stocks looking?
I think they're looking okay. I mean, a lot of them had big sell-offs and coming off some bottoms. Ford, for example, had a big sell-off, and it seems to be recovering. Rivian, which is another name, has been recovering a little bit. Tesla seems to be holding up. They just split the stock 3-for-1. Everybody thinks Tesla is headed down a bit because of all the competition. I don't know if that's true or not, but there might be a lot of business for a lot of people, and of course they led the industry from the get-go. So, from what I hear, people are buying. They're not cheap, but there are government subsidies and other things that are apparently going to be coming out or are out. So I think, I think it looks okay. But here's the problem. I mean, if the stock market is in a big decline, is it going to do like First Solar did, as I mentioned a few moments ago, not want to go down when the market's down 1,000 points, or will they be responsive to the overall market? And as a general rule, if you're in a bear market, the baby gets thrown out with the bathwater. So you got to be careful and make sure that you're taking the time frame that you're looking for in investing, because it may not be a trade, it may be a long-term play.
Are there sectors you're bullish on right now?
Well, we've gone over them. I like solar. I like crude oil. I like natural gas. I do like the commodities. So there are always individual stocks that we could trade, particularly those related to food and so forth. But those would be my main areas right now. And then when the market finally bottoms, it may be a nice trade here in the next few weeks. Maybe you can go long just about everything for a year-end rally, perhaps. But just in terms of sectors that are standing out here, and I think will go beyond any short-term move in the market, I think solar, oil, natural gas, and commodities would be my bet.
The autumn equinox is less than a month away on September 23rd. Could this be an interesting time for markets?
It is. It will be. I hope so. We generally see, we've talked about this, it's the big autumn cycle there, so let's see if the market heads lower, as it should this time of year, and it should bottom somewhere. If it heads lower, as I suspect, it should bottom sometime within a few days of that September 23rd. The summer solstice was the 21st, and the market bottomed on the 17th. So let's see now. If I'm wrong and the market explodes here and they reinvent the wheel, then that'll be a time for a top. So let's see if the market suddenly reverses, which I don't expect, but we always have to keep flexible if you're trading.
Mark, I know you like to take note of geocosmic events like solar storms and so on that could disrupt satellite communications, which means basically you're isolated and the internet won't work. Are there any geocosmic things right now that have you interested or concerned?
Well, I'm always checking, the websites out there that, from NASA and from other sources that, search the solar. Actually, there's one site in particular. I just hesitated because I think it's a good one for your listeners, called spaceweather.com, and it does track solar activity. There doesn't seem to be anything on the horizon today. I'm just checking the website now, but there had been some unusual movements on the sun and some unusual sunspots and so forth. They say a small magnetic filament on the sun erupted yesterday on the 25th. That was hurling some halo CME into space. So they said there's a 50-50 chance it would hit the Earth on the 29th. So let's see if that has any effect on us. I'm just reading this off the spaceweather.com, and that's, NASA and others track these things. You just never know which one is going to affect us. There is some strong flare activity according to the report today. So there are some solar flares going on. You can laugh about this all day long, but, There have been some in just recent weeks that took out shortwave radio in Asia, and they don't report all this stuff. But if there's one of those Carrington events that we've talked about that we experienced back in the mid-1800s, it could wipe us out in terms of our technology. It could be just fry everything. So it's something to keep an eye on. You can't sit here worrying about it. It's like you can't worry about an asteroid or anything like that, because by the time you worry about it, it's too late. But it's certainly interesting stuff to monitor, and what it says is that man doesn't have much control. We think that the Federal Reserve, if you listen to the news, the Federal Reserve is all that matters. The entire fate of the planet depends on what Jay Powell does at Jackson Hole, and I laugh at this because this is just a human being, an incompetent one at that, based on the history of the Federal Reserve, and then we're looking at other things that could have greater impact, such as these planetary events. So anyway, thanks for mentioning it.
Mark, where can people find out more about your special offer?
Go to vrtrader.com, Victor Robert, vrtrader.com, and you'll see all our newsletters. We have metal resource letter, cannabis letter, market timing letter. You can buy my book, all kinds of interesting stuff there. But doing it for about 43 years and consider myself a survivor, so glad to do it.
Mark, thank you so much for being on This Week in Money.
Thanks for having me.
My guest has been Mark Leibovit, editor and publisher of the Leibovit VR newsletters. He was speaking to us from Arizona. Our conversation took place on Friday, August 26th. Coming up, Bob Hoye, next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He's speaking to us from Vancouver. Welcome back to This Week in Money, Bob.
Yeah, Jim, and looking over our shoulder, it was an interesting week in the financial markets.
And we have lots of listener questions to answer on the show, so we'll get right into those. Our first question comes from Peter. Hi, Bob. I know you're calling for an end to the commodity cycle and the financial credit boom. This implies that commodities will go down in value. Does this include oil, which continues to face supply shortages and limitations due to war, deliberate government interference, and the push for green alternatives? If so, won't oil remain in demand or at least high-priced for the foreseeable future? And doesn't that mean agricultural commodities will remain elevated too? How will the bust in these commodities work when it seems we're going to be on an ongoing slow burn supply crisis everywhere? Regards, Peter.
Yeah, Peter, you've assessed current conditions, and what our work is on financial bubbles. And when you're in the final stages of a great financial bubble, the business boom pushes up commodity prices. And indeed, in real terms, and this is important, the adjusted for inflation, the copper's price typically goes up in a great financial boom, in which it did do, but now it's toast, I'm telling you. And then the other one that you get within a great financial boom is that gold's real price goes down, and that's what's happened. It hasn't turned up yet. So anyways, to get to the point that following every great financial mania, the contraction was severe enough that most, if not all, asset prices go down. And so this is where that in the boom, as we've had lately because of incredible government interference, there are shortages. But then there's been many booms in the past where there were shortages. And then there's the difficulty with high prices, because prices always go up faster than wages. So then you have the problem of shortages and high prices. And then afterwards, when it's all over, there's been observations made that here we are, and of course people are unemployed. So then the question is, how can you have hard times in the face of plenty? So this is what happens. The whole world changes. And I expect crude oil to go down with the others. Now, there's one positive for the agricultural commodities that we've been on for a few years, is that with global cooling coming in, it will shorten, actually it has been, shortening the harvest season in the northern hemisphere. So there's always that possibility. But then earlier in the year, with the shortages, with prices soaring, and then droughts reported here and there, and then floods there, here and there, and then the problem Ukraine. So there's a whole bunch of shortage stuff already in the market. So I'm content to think that our game was that commodities could be firm in about mid-year and maybe dither around in August, and then after August head down. And we'll stay with that. And thank you for your question.
Another question from a person named Peter. I assume war is bad for markets, at least initially, but what do you think the consequences of a drawn-out war in Ukraine will be for the rest of the West and here in North America?
So what about the war in Ukraine? Recently I had an article published in Canada Free Press, and it outlined that as we go into this contraction, those who would prosecute war are going to run out of money. And in which case, Russia is probably out of money already, and you have to have real money to fight a war, and I think opposition in Russia is mounting. So I think Russia won't be able to afford its misadventure in Ukraine for too much longer. Then we got another question.
What, if any, is the connection between war and financial cycles?
Okay, good one, because with the advent of financial markets in the late 1600s in London, by then, about 1660, 1670, you had enough stocks that were being traded or publicly owned, and you had enough traders so that you could call it a stock market. So then you had a major war, and the commodity prices reached a couple of generations high in 1711. And looking back on it, you could call it a commodity supercycle. And then a decade later, in 1720, you had the financial bubble blow out, and then you went into the crash and the contraction. So the war is part of a mania that drives commodity prices up. So if we want to move ahead to commodity prices, which made a terrific peak in 2008, and at the time, our work covers base metals, of course, and so we were doing base metals, copper, lead, zinc, usual stuff.
Do wars always bring more inflationary pressures?
Yeah, and then so we deflated base metal prices by the producer price index, and the gain was huge, maybe a double to the boom in 2008. And it was bigger. It was more than anything on a 100-year chart. So it was a super commodity cycle, or whatever these guys call it. And it completed. And then the other one in 2011, you then had the huge boom in gold and silver up to $50. And so those two together was a super commodity boom. And then about a decade later, you'd expect the equivalent boom in stocks and bonds to complete, and it has. January this year. Hey, is that a decade after 2011? So yeah, the wars, commodities, and great financial markets all fit into a pattern. So yeah.
And the final part of this long question, is there a delay in the economic effects between the start of a war and how it cycles through the economy?
Yeah, that's sort of an overall question. We would, as I said, the piece I just published recently was more immediate, with the contraction ending the ability to fund wars. So we think that Russia won't be able to fund its intrusion into Ukraine, and maybe the collapse could be fast enough that China will end its focus upon Taiwan, focus and threats upon that. So we're going the other way now. This business of wars pushing commodities, that was 20 years ago.
Our next question is about Joe Biden's student loan forgiveness. Do you think that this is going to cause inflation and that perhaps that this is the worst time possible for this to happen? Is that true?
Oh, God, it's not going to, it is probably, no, it's shifting money from one pocket to another. And it's a dreadful, dreadful program where ordinary working people are going to be, the cost per person on this relief is about $2,000. So, and it's straight, pure hardball politics. And they're taking money from ordinary people and giving it to people who can advance their career in university life. And that, in turn, advances the careers of academics and professors and all that stuff. When most colleges are state-run, it's all part of the game. So this one, I think, is a major blunder. It will not help the Democrats.
And our last listener question, again, a multi-parter. To play devil's advocate, Bob, how do you view the underlying bullish tone to the markets despite all the bearish surface worries?
Yeah, in the first half of the year, that whack to the market was one of the worst in a couple of generations. So then you'd have a rebound out, and then oftentimes you can have a little positive sentiment going into September. But the underlying part of the market, the health, everything else, there's just too many traps out there. It is not a healthy market these days. Now then, the next question.
I've talked to several advisors in the past 2 months who are really adamant this is an awful time to sell anything. They've recommended big increases in stock exposure with the sell-off. What do they see and what are they missing?
Yeah, I've got to go back to December, January. We were looking at the strength in the markets, and then one that we do whenever it seems appropriate is in history there's a pattern whereby a really strong financial phenomenon can peak in January. It was gold and silver in the crazy mania of 1980. That was in January. Then there was the bull market for New York that peaked in January of 1973. So we used those as examples and noted the overbought. And then in early January, the Advanced Decline Index, which had peaked in the November, it broke down. It took out key levels. So that's what we said. This is it. This is now we're going to go into a post-bubble contraction. Stocks would go down, and quite likely the economy would go down with it. So this is then the advice was to raise as much liquidity as you could. So now the mainstream brokers here that you mentioned, I think they obviously missed the decline. They don't understand its dimensions, and they're thinking that this is a great time to buy. Well, we've got a quote from 1929 about buying the dips. I think it was September 1929 when that was out. So hitherto, the successful strategy was to buy the dips, and then all of a sudden it wasn't, and that's the way these markets go. So anyways, yep. What are they missing? I think they're missing doing a complete and thorough study of financial history. And everybody should do it.
And the last part of the question, if the S&P Standard & Poor's exceeds its record highs, what would change your mind or expected timing for the end of the financial cycle, or does it depend on other things? What would change your mind that it's a resumed bull market? Well,
certainly S&P or the broader New York Stock Exchange composite reaching new highs, you'd have to take a look at it. But at the moment, I'm rather doubtful. The last week in the market was a little concerning when we were thinking maybe you might have a nice little positive pop into September. So the market is actually deteriorating. So, but it's like any research or any trader. If something distinctive comes along, you'd have to pay attention to it. But in the meantime, internals in the marketplace and credit spreads. Here's one that is, we have the charts on the yield curve, which is the difference between long rates and short rates, in the U.S. all the way back to 1857. And there's many business cycles in that one, and the rule is that every inversion of the curve, which means that short rates get higher than long rates, every inversion has been followed by a recession. And then the other sort of sub-little rule on that one is that the more intense the inversion, the more severe the following contraction can be. And I looked at it the other day, and this inversion is, it's fairly intense, but there have been more severe ones. But anyways, the key message is that the curve inverted, and a recession is always associated with that.
Bob, some of the headlines that caught your attention. Biden energy czar tells poor people to buy solar panels.
Oh, yeah. It's like Marie Antoinette telling quipping that people, they can't buy bread, so let them buy cake or whatever it was. So, no, this is just some elite government person who is off on a message, on a mission, and the mission is to change the economy from a free market economy to a fully administered economy, and getting into these solar cells and wind turbines has been a major mistake. So, yeah, it was. I like the headline.
German power prices smash records.
Oh, yeah. Yeah, and again, this is the problem with inadequate policies. They went crazy and decided they have to have power from windmills and from solar cells, which is intermittent power, which screws up the grid. And then they were shutting down coal thing, and then after the nuclear incident at the power plant in Japan, they set a program to shut down nuclear plants, which was just crazy. So, and then, of all things, end up being dependent on Russia for natural gas and crude oil. And I remember in the early 80s, Reagan warning Europe not to get reliant upon Russian energy supplies. So, hey, they made all of the wrong errors, and they're now paying for it. And of all things, Jim, the other day I stumbled on a chart of the cost of firewood in Germany back to 2005, I think it was. So it was just up and down seasonally, no major uptrend. And then all of a sudden, in the last year, straight up to some extraordinary high price. So even firewood has had its bid and is right up there. So the problem is amazing blunders with authoritarian governments.
Still on the energy front, headline, electric vehicle charging stations go dark as China rations power.
Yeah, I like whoever wrote that headline. Power goes dark as they... I think they haven't got enough energy, not enough electricity, and no matter how fast China builds coal plants, the demand is great. But I think also maybe something to do with drought and dams and electrical power like that. So there's a combination of things that are hitting China's power delivery now. So, anyways, it's fascinating.
Bob, if somebody wants to take their company public, not a good time to do it. Headline, the IPO market faces worst year in 2 decades.
Yeah, that's going back. And, Jim, I still think of them as new issues. That's what we used to call them decades ago. A new issue, new stock issue, and they call them initial public offering, IPOs. Okay, and it's also very much part of a bull market where, and speculators are very keen to buy new stocks because it becomes a phenomenon all its own, and you then have companies coming to the market that maybe are a little doubtful, not good quality, and they can get floated, and then the IPO market is over. So there's been a number of formerly hot IPOs getting trashed. So this eventually shuts down the new issue market, which this headline is about. And it's also symptomatic of changing from a boom to a bust.
Headline, Wall Street sees another big commodities rally in 2022.
Yeah, we talked earlier about commodities, and there's guys that go on about this commodity super cycle, and they didn't recognize that 2008 and 2011, as earlier in the show mentioned, that was a measurable commodity supercycle, and it's been followed a decade later by a great financial bubble, and every great financial bubble is followed by the most asset prices going down. So the previous supercycle commodity high was in 1920, following the 1914-18 war. And you want to talk about rising prices. In the U.S., it drove the consumer price index inflation up to above 20%. I think it was 24%, which would have been a hell of a shock. I mean, they're all upset now about 9% increase. And then in 1921, with the global crash in commodities, ending that supercycle for commodities, the U.S. price inflation went down to I think it was minus 14. So then you had the Federal Reserve System spending the greater part of that decade, the 1920s, worried that inflation wasn't high enough and keeping the money taps open, not understanding that the world was in another great financial bubble. So they made the financial bubble greater than it would have been otherwise, and they didn't have anything in the arsenal to prevent the crash when it came in. So here we are now. You had the super cycle for commodities with the last go at it in 2011, and then the Fed spent most of the decade being worried that inflation wasn't high enough, so they had the money spigots open, not understanding that the world was in another financial bubble. I mean, these guys are unbelievable. They're fully up on theories, which are essentially intuitive, and they absolutely refuse to look at financial history. And it's amazing, but it's also fascinating, Jim.
Bob, thank you so much for being on This Week in Money.
Jim, good to be with you, and anytime.
My guest has been market historian Bob Hoye, the chief investment strategist for chartsandmarkets.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Mark Leibovit, and Bob Hoye. And thank you for listening. People like Bob love answering your questions. You can send them to info@housestreet.com. Now stand by for a company showcase update from Zarko Meseldzija.CTO of American Manganese, doing business as recyclable battery materials. This week's show is on BitChute at Talk Digital Network. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Zarko Meseldzija. He's the Chief Technical Officer at American Manganese, doing business as recyclable battery materials. Welcome back to the show.
Thank you, Jim.
You guys have been very busy the past week or so. A number of news releases have come out. Can you tell us about them?
Yeah, definitely. Why don't we just go in order? Obviously, the most recent one, we announced 99% lithium extraction from LFP battery cathode materials. This is major news. I think this was a logical step for the company in regards to our business model, and I know we have received a lot of questions about LFP before, but rest assured that we do our market research, and we found that the mass adoption of LFP was inevitable, and an efficient recycling solution was necessary. Even from our discussions with potential strategic partners, we see that they don't use only one cathode chemistry, such as like an NMC or NCA, but they also offer batteries and EV models that use LFP. Therefore, if we want to strengthen our business model's value proposition, and which is licensing and joint developing a recycling process, we need to offer them a complete solution. And to be quite honest, from earlier on, from a value perspective, there wasn't much of a business incentive to recycle LFP batteries. But with lithium prices currently sitting around $70,000 a metric ton, it does benefit the economics, and that's if you can get the lithium out. Of course, you need an efficient recycling process to actually extract the lithium, which we have demonstrated along with other cathode chemistries such as NMC, NCA, LCO, and LMO. All of these lithium-ion battery chemistries, of course, containing lithium, which is kind of that key element. It's also really important to highlight that our ability is to, extract high purity lithium, because the current trouble with commercial recycling tech is that the high heat process really is only targeting nickel and cobalt extraction, while the lithium ends up in a slag material, and that becomes very difficult to recover. I mean, some will say maybe it is possible to recover, but what are the kind of what's the cost-benefit analysis on this? How much is it going to cost to actually recover and go through, and to what purity is that lithium, right? And those are all important things to ask. And on a final note, which we also mentioned in the press release, is that according to Benchmark Mineral Intelligence, China's forecasted share of LFP production in 2022 is 99%. And this segues really nicely into our other press release, where we commended the climate-focused bill signed by Joe Biden. The bill is formally known as the Inflation Reduction Act, but it has a major focus on clean tech, which gives our industry a big push on the back. I know we talked about in the previous podcast, but the language around the bill offers a tax credit for EVs, and of course they come with restrictions on where the batteries are built and where the critical materials are mined, recycled, or processed. And that threshold rises up until the end of the decade, so it kind of goes in this tiered approach, I think from like 40% to 80% or some 100% in some cases. But now if you think about it, if China has a 99% of the forecasted share of LFP production, there's going to need to be a monumental shift to even reach the first threshold percentage for domestic supply of EV batteries. And it's not just LFP, they also hold a majority share in material refining, cathode, anode production, and battery manufacturing for other battery chemistries as well. So this is, definitely a push that we're seeing, and it's not just the U.S. We saw here in Canada as well. The Canadian government signed MOUs with Volkswagen and Mercedes, who are looking to have an invested interest in our critical materials and bringing that industry here in Canada and working with some of these major companies. So you're seeing it, Canada, U.S., throughout Europe, and this is the industry that we are a part of, and recycling is really going to be inevitable in all of that, right? And finally, I just want to save the best for last. Of course, as everybody saw, the leach section of our technology for the demonstration plant testing, we have achieved 163% of that demonstration plant's processing capacity for lithium-ion battery production scrap. Now, this equates to 815 kilograms per day. Now, this is huge news, and we are really excited about this because the leaching step is core to our patents and our patented process. And these new processing parameters, or what we're able to achieve at the scale that these scaled up conditions, really opens the door to a lot of possibilities when it comes to even further scale up into the commercial design. Now, I've been asked the questions, kind of what happens to the other stages of the demonstration plant. I just want to say that the leaching step is a chemical reaction, which really makes it the limiting factor. And knowing the leaching stage's potential allows us to match that limit to other process stages, especially when it comes to design. Now, scaling up a process is not an easy task. It's one thing that's always asked in new technologies. Is it scaled up? How does it scale? But in the case of the demonstration plant, we've obviously demonstrated really smooth operating conditions and an even higher throughput than expected, which is a very valuable data point. The leach data will be analyzed, and we also have other stages of the demonstration plant left to test. I just want everybody to think of it as kind of like a 5-stage process. So we have pre-leach, leach, filtration, precipitation, and lithium recovery. So now we're moving forward to the filtration stage. So that's taking out any impurities in the leach solution, and we'll provide updates on those as they're received. Now, there is a lot of work happening in the background, as you can see with LFP. There's a lot of testing for different companies. We got the support from the Canadian government as well that I've spoken about on the fluoride removal. But our team's core focus is a demonstration plant, which seems to also be attracting more visitors for in-person meetings to see the plant, and I think that's the real game changer when you see the scale of the process. But yeah, that's all for this week, Jim.
Zarko, is one of the most important things is that this process is patented in a number of countries interested in recycling batteries.
Yeah, yes, exactly. And countries are leading in battery innovation, right? And I think for us, one major key point is how early we started in this work, right? Because scale up does take time, and we had a head start and really saw the potential for recycling way back, and now with the demonstration plant, really the proof is there when others come and see it.
Where are you traded, and how can they get more information?
Get a hold of us. You can find a lot more information on our website, www.americanmanganeseinc.com. You'll find our emails, phone numbers. Feel free to call the office directly as well. And we are traded on the TSXV under the ticker symbol AMY, on the OTCQB under AMY.ZF, and on the Frankfurt Stock Exchange under 2AM.
Zarko, thank you so much for the update.
Thanks, Jim.
We've been speaking with Zarko Meseldzija, Chief Technical Officer of American Manganese, doing business as Recyclable Battery Materials. I'm Jim Goddard. Our conversation took place on August 26th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.